Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Wendy's.
If you find our talks useful, please consider subscribe, like, and comment underneath. And real quick before we jump in, the VIP Algos link is below in the description, so definitely be sure to check that out.
Yeah, absolutely check it out.
So I want you to imagine something for a second. Imagine you wake up, right? You grab your coffee, check your retirement account, and you see your safest, most boring legacy dividend stock.
The one you just ignore, basically.
Exactly, the one you tuck away for 5 years, but suddenly it is trading with the violent volatility of like a Silicon Valley tech startup.
Oh, wow. Yeah.
Right. You bought this household name for this steady quarterly dividend, and then on a random Tuesday, it's skyrocketing. Your reliable utility play is suddenly behaving like a literal meme coin.
Which is exactly what just happened to Wendy's. It's really the ultimate market whiplash.
It really is. And, the contradiction at the heart of this entire story is just massive.
Oh, totally. Because, if you look at the fundamental wealth-building context of the company, it is facing severe operational crises. Store sales are struggling. The franchise owners are financially squeezed to the breaking point.
Right.
Yet, despite all of that grim reality, the stock price just experienced an absolute explosion.
A 40% explosion, to be exact. So, our goal today is to figure out how that contradiction can even exist. Like, we need to know if this is just a fleeting sugar rush driven by internet hype, or if we're actually seeing the beginning of a legitimate corporate renaissance.
Yeah, and the answer is buried somewhere between the company's deeply stressed balance sheet and this sudden massive surge in trading volume.
So let's jump right into the sizzle, because the price action on this, it's just staggering. We are talking about Wendy's stock surging 25.7% in a single trading session.
It's huge.
It's massive. According to the data, that was its biggest single-day advance since June of 2021. And, the momentum didn't even stop there. It followed that up with another 9% gain the very next day.
So a two-day tear of over 40%.
Exactly. And a move like that, well, it doesn't just happen by accident.
No, it doesn't. But what's crucial to understand here is what did not trigger it.
Right.
We didn't see some surprise earnings beat. There wasn't this sudden massive shift in consumer behavior where everyone, just decided to eat fast food twice a day.
Obviously not.
Right. This was driven entirely by a massive wave of retail trading. Vanda Research tracked the flows and noted that this was the second biggest day of retail net buying for Wendy's stock since 2012.
And what's wild to me is the company it was keeping. The only momentum names seeing more retail flow at that exact same time were NVIDIA and SpaceX.
That's insane.
Right. We're talking about a legacy burger chain rubbing shoulders with literal AI supercomputers and rockets going to Mars, just in terms of sheer trading volume.
Which tells us, fundamentally, that this is a story about market mechanics, not hamburgers. To really understand the 40% jump, we have to look at the technicals, specifically the short interest heading into this rally.
Okay, let's get into the mechanics.
So, short interest on the stock was sitting incredibly high. It was heavily concentrated at roughly 32 to 34% of the float.
Let's break that down for the listener for a second. That means a third of all the tradable shares on the open market were essentially bets by investors that the company's stock was going to drop.
Exactly.
They borrow the stock, sell it, and then they just pray the price falls so they can buy it back cheaper and, pocket the difference.
Yeah, it's pure supply and demand. When you have that much negative betting and suddenly this unprecedented wave of retail buying volume hits the market, it creates this, a structural trap.
Right.
The price starts to tick up. And those short sellers, they start losing money on their bets fast. So to close those losing bets and stop the bleeding, they're forced to buy the stock back.
Right, which creates a cascade.
Exactly. Their desperate buying pushes the price even higher, which forces the next tier of short sellers to buy, pushing the price higher again.
It's basically a game of financial musical chairs.
Oh, that's a great way to put it.
Yeah, a third of the players suddenly realize there are no seats left, so they start bidding violently just to survive. It's a textbook short squeeze. But look, a short squeeze is just a sugar rush, right?
Eventually, yeah.
Eventually, you run out of desperate short sellers, and the stock price has to be justified by actual burger sales. And right now, those burger sales are telling a completely different story.
They really are.
So let's transition from the momentum algorithms to the actual fundamentals, the cold, hard menu, if you will.
Yeah, we really need to look at the fundamental reality of the business in Q1 of 2026. The picture there is, it's remarkably grim. And it starts with a rather confusing paradox in their revenue reporting.
Yeah, looking at the operational reality in the financials, the top line numbers look okay at first glance. Like Q1 2026 revenue was technically up 3.3% to $540.6 million.
Technically up, yeah.
But when you look under the hood at how the actual restaurants are doing, global system-wide sales dropped 5.5%, and U.S. same-restaurant sales fell a really steep 7.8%. So corporate revenue is technically up, but actual sales at the local stores are plummeting.
Which is the classic quirk of the franchise model.
Mm,
A parent company can boost its top-line revenue through, collecting various fees, tweaking supply chain costs, or forcing franchisees to pay for marketing initiatives.
sure.
But the true health of the brand is measured by same-restaurant sales, meaning, are the existing stores selling more food this year than they did last year? And dropping 7.8% in the U.S. means they've hit a fast food inflation tipping point.
Basically, the listener who used to grab a $5 combo meal is now being asked to pay like $12, and they are simply choosing to make a sandwich at home instead.
That is the core issue right there. Consumers are balking at the prices, foot traffic is down, and the consequences of that are just devastating for the people actually running the restaurants.
Let's talk about those people, the franchise owners, because the margin squeeze happening here is alarming. Corporate operates some stores, but franchisees operate the vast majority of them.
Right.
For the company-operated restaurants, profit margins dropped to 11.4%. But the real alarm bell is the franchisee margin, which fell to just 9.3%.
That's rough.
Let's ditch the Wall Street jargon for a second. We are talking about cash profit before taxes. For every $100 a customer spends at the drive-thru, the owner is keeping barely $9.
And that $9 has to cover, emergency equipment repairs, loan payments on the building, or sudden spikes in labor costs. There's an immense amount of strain on the core business model here.
Barely any breathing room.
None. If minimum wage goes up in their state, or if the cost of beef spikes, that 9.3% margin can evaporate into a net loss overnight.
So put yourself in the shoes of that franchisee. You're exhausted, your margins are razor thin, and fewer people are coming through your doors. This severe financial strain across the network directly impacts the corporate entity. Which brings us to the elephant in the room, the debt and the massive dividend payout.
Yeah, Wendy's carries a very high debt load relative to its equity value. Historically, they've serviced that debt and paid out a very generous dividend, yielding somewhere between 7% and 8.9%.
Which is huge.
It is. And they could do that because the franchise model usually generates steady, predictable cash flow, rain or shine.
But if U.S. sales are dropping nearly 8%, that cash flow isn't reliable anymore. And looking at the numbers from Q1, their adjusted earnings per share came in at just 12 cents. Their massive quarterly dividend payout essentially matches that entire earnings number.
Wow.
Yeah, they are paying out basically everything they earn just to keep the dividend alive.
It's a terrifying trap for a legacy company. I mean, they are terrified of cutting the dividend because that yield is the only reason many institutional value investors still hold the stock.
Exact.
If they cut the payout to pay down their debt, those large funds will just dump the stock.
Right.
But if they keep paying it while the franchisees are drowning, they risk breaking the bank entirely. The margin for error is effectively zero.
So we have this really grim fundamental reality. Stressed franchisees, plummeting same-store sales, high debt, and a hostage situation dividend. Why would anyone, besides the meme stock day traders, touch this?
Well, there's one very specific reason why big institutional money might still see potential here.
The catalysts.
Yes, the catalyst. And it comes down to the new leadership team, the fixers.
Leadership change is often the ultimate catalyst in a turnaround play, and Wall Street is paying very close attention to this specific duo. Wendy's brought in a new CEO, Robert Wright, and he recently tapped Steve Cirulis as CFO and Chief Strategy Officer.
And they aren't just random executives shuffled from another boardroom.
Right.
They have a very specific reputation on Wall Street for doing exactly this kind of dirty work.
Right. They previously worked together and famously orchestrated a massive 500% turnaround at Potbelly.
A 500% turnaround is no joke.
No, it's not. They're viewed as operators who know how to walk into a distressed food service brand, stop the bleeding, cut the fat, and completely reverse the trajectory. They have a proven, tangible track record.
And they have a playbook. They're calling it Project Fresh. Now, here's where the data gets genuinely interesting. When they implement this Project Fresh playbook in a controlled environment, meaning the restaurants that corporate owns and operates directly, Those stores outperform the rest of the struggling franchise system by a very noticeable 3.1%.
Which proves the concept.
Exactly. It shows that their operational initiatives, whether that's redesigning kitchen flow, optimizing labor schedules, or tweaking the menu to drive higher margin items, they actually result in a positive financial response with perfectly implemented.
Plus, they have the China deal.
Right? They have an international growth narrative to lean on. They recently signed an agreement to build up to 1,000 restaurants across China over the next 10 years, which offers a massive expansion runway completely insulated from the struggling U.S. market.
I hear you, but let me throw an analogy at this. I watch a lot of kitchen nightmares.
Okay, I love where this is going.
You can have Gordon Ramsay come in, design a brilliant, streamlined menu in a pristine test kitchen, and prove mathematically that it makes money. But it is a completely different challenge to get an exhausted, financially strained restaurant owner in the real world to execute that menu perfectly every single day.
Oh, for sure.
Wright and Cerealists clearly have a recipe that works in a corporate lab, but corporate stores are labs, real franchises are battlefields. Can they force a sprawling network of deeply stressed franchisees who, again, are scraping by on a 9.3% margin to adopt this new playbook? Remodeling kitchens and retraining staff takes capital. It takes buy-in.
You've hit the nail on the head. That is the multi-million-dollar question. Operational turnarounds of this scale, they take years to execute. You have to rebuild trust with thousands of independent franchise owners. You have to shift consumer perception in a highly competitive market. It is a slow, grinding, painful process.
Which means a slow, grinding turnaround plan completely fails to explain a 40% stock explosion in 48 hours.
Exactly.
Fixing supply chains takes years, short squeezes take minutes. There has to be a much more immediate, aggressive catalyst driving the stock's narrative right now to justify that kind of violent price action.
And that brings us to the wild card. Turnarounds are slow, but mergers and acquisitions are instant. We have to look at the prospect of a complete private equity buyout.
Enter the activist investor, Nelson Peltz of Tryon Partners. He is a longtime, highly influential shareholder, and the recent filings reveal that he made aggressive open market purchases of the stock at $7.14 a share in April of 2026.
And when a billionaire activist investor starts buying up shares in the open market, it acts as a massive signal to the rest of the financial world. It tells the market that he believes the stock has found its absolute floor.
Right.
But an activist investor doesn't just buy shares to hold them. They buy influence to force a change. And right now, there is heavy, sustained chatter that Peltz might simply decide to take Wendy's private.
Let's explain why taking it private makes sense. If the company is struggling and needs to make painful changes, like cutting the dividend or forcing franchisees to spend money on remodels, doing that in the public market means your stock price gets punished every single quarter by Wall Street.
Oh, absolutely hammered.
Yeah. Taking it private allows you to fix the plumbing behind closed doors. And Wedbush analyst Michael Piccolo has added fuel to this fire, arguing a buyout could feasibly happen at a price between $9 and $12 per share.
The math on that is what's driving the frenzy. If the baseline price before this meme rally was hovering around that $7 range, a $9 to $12 buyout represents a massive 40 to 90% premium over the pre-rally price.
That's a huge jump.
It is. When numbers like a 90% guaranteed premium start floating around the internet, it acts like a magnet for speculative retail capital.
But hold on, we need a reality check here. Let's look at the bear case and the risks. Are we giving these retail traders too much credit? You're framing this as if they are brilliantly front-running a lucrative private equity buyout.
Why?
Couldn't this just be unconfirmed rumors on message boards feeding a hype loop? Like, if Nelson Peltz wakes up tomorrow, looks at the toxic debt load, looks at the fractured franchise base, and decides he doesn't want to buy it after all these retail traders are left holding the bag.
It is a phenomenal risk. Buying on an unconfirmed buyout rumor is essentially paying a massive premium for hope.
Exactly.
If Peltz walks away, that speculative premium evaporates instantly. The stock would violently reprice back to its fundamental reality, which, as we established, is burdened by debt and shrinking margins.
Which is exactly why the battle lines are so clearly drawn in 2026. We have this anchor of struggling fundamental reality pulling the stock down, and this helium balloon of turnaround hype and buyout rumors pulling it up. So looking ahead, how does this tension resolve?
The timeline really hinges on the upcoming Q2 earnings report. This event will be intensely scrutinized because it serves as the first full quarter under the new Wright and Searle duo.
No more grace periods. The market is going to demand proof. They will want to see if that brutal 7.8% U.S. sales decline has even begun to plateau.
And investors will be laser focused on those franchisee margins. If that margin continues to drop below 9.3%, panic will set in because the franchise network will start cracking.
Right.
However, we also have to factor in macroeconomic tailwinds. The broader market is currently anticipating potential interest rate cuts. If the Federal Reserve lowers rates, that directly lowers Wendy's substantial interest expense on their massive debt burden.
Which is huge for them. Refinancing debt at lower rates frees up crucial cash flow, which gives them breathing room to protect that generous dividend payout. But let's reemphasize the bear case because it is severe. If U.S. demand stays weak and consumers simply refuse to pay inflated fast food prices, the Project Fresh playbook might fail to gain traction regardless of how good the leadership is.
Right, because stressed franchisees simply will not spend capital to upgrade their kitchens or adopt new tech if they're losing money every single month.
And if that friction occurs, unit growth stalls out completely. Combine stalled growth with high leverage, and you triggered the nightmare scenario, a dividend cut.
And as we've seen time and time again, once a legacy brand cuts its dividend, the traditional value investors abandon ship immediately. Furthermore, you have the persistent mean volatility risk. The retail buzz that drove that 40% surge can evaporate the second a new, shinier stock appears on the internet.
So bringing this to our final verdict, the final assessment on this data reflects this extreme polarization perfectly. They give Wendy's a 7 out of 10 bullish score, but with a massive asterisk.
A very big asterisk.
Right. They classify it specifically as a high asymmetry turnaround play and a speculative swing trade. So we're definitely not telling you to buy or sell. But the data is explicitly warning that this is not a safe buy and hold forever investment.
No, not at all. The contrast in market sentiment is one of the widest divides you will ever see in modern finance.
Oh, easily.
On one side, you have the retail investors and the activists who see a turnaround rocket ship fueled by short squeezes and massive buyout premiums. But on the other side, you have the cold institutional reality check. Right now, 16 different Wall Street analysts currently maintain hold ratings on the stock, with a median price target of just $7.84.
Let that sink in. $7.84. That is deep institutional skepticism. That is Wall Street looking at a stock that just surged over 40% on immense volume and saying, we don't buy the hype, show us the actual earnings first.
It perfectly encapsulates the modern market battleground. The high-frequency algorithms and the retail momentum are engaged in a tug-of-war against traditional cash flow models and fundamental analysis.
Which really brings us to the long-term view of this entire discussion. The Wendy story in 2026 is about so much more than hamburgers. It proves how modern financial markets can take a legacy brand, a company facing very real, very tangible operational crises with everyday business owners, and mutate it into a speculative frenzy.
It is the violent collision of high short interest, retail momentum, and activist buyout rumors.
Exactly.
And it illustrates a fundamental structural shift in market mechanics that every investor needs to understand. We are operating in an environment where supply-demand imbalances in a stock's tradable shares can completely override traditional fundamental valuations. The actual business of selling burgers and fries didn't change overnight, but the mechanics of the stock completely detached from reality.
And that is exactly why you should care about this story, even if you never plan to buy a single share of a fast food company, because it forces us to ask a deeply uncomfortable question about the stock market you entrust with your savings.
It really does.
So I want to leave you with a final thought to ponder today. If a massive, decades-old legacy brand can trade like a wildly volatile meme stock based purely on social momentum and the whispers of a private equity buyout, what does that mean for the concept of traditional value investing?
That's a great question.
Right. When a sudden wave of retail volume can overpower the caution of 16 professional Wall Street analysts in a single afternoon, are we all just trading momentum now, no matter what actual business is operating underneath? Think back to that boring, safe dividend stock you thought you owned in your retirement account. Because in today's market, the X-ray machine is broken and nothing is as predictable as it seems.
A really sobering thought to end on.
It is. But that wraps it up for us today. Once again, if you found this helpful, be sure to subscribe and don't forget to check out the VIP Algos link in the description below. See you next time.